If you're flipping a property and you think a fresh coat of paint keeps your tax bill low, you might be about to hand the ATO an extra 100,000. I'm a tax accountant and I see this mistake constantly with clients who renovate and sell property for a living. It's not about whether you painted the walls or replaced the carpet. It's about one word: substantial. Get that word wrong, and it can change your GST bill by tens of thousands of dollars on a single sale. The basic rule is simple. When you sell residential property in Australia, that sale is normally input tax. That means no GST on the sale, but it also means you can't claim GST credits on your renovation costs either. That's fine if all you did was freshen the place up. Paint, sanding the floorboards, a new kitchen bench top, replacing old carpet and light fittings. The tax law calls this cosmetic work, and cosmetic work by itself does not change anything. The property stays input tax. No GST on the sale and no GST credit on what you've spent. But if the renovation goes further than that, the property can become what the law calls new residential premises, and that flips everything. What actually counts as substantial? The tests come from a binding ATO ruling, and it looks at two things. Does the work affect the building as a whole? And does it remove or replace all or nearly all of that building? In practice, that means things like knocking out internal walls to change the layout, turning a spare room into an ensuite, ripping out the entire electrical and plumbing system and starting again, or adding a second story or a new bedroom. Replacing the roof, the floor joist or other major structural elements counts too. Once you've done that level of work, any painting or cosmetic touches you added along the way get swept into the same category. The whole project becomes a substantial renovation, and the property is treated as a brand new for GST purposes. This is what it actually costs you or saves you depending on which side of the line you land on. If the renovation is only cosmetic, there's no GST on the sale, but you can't claim back any GST you paid on renovation costs. If the renovation is substantial, you now owe GST on the sale 10% under the standard rules. The upside is you can claim GST credits on your construction and renovation costs. So say you've spent 200K on a full structural renovation, GST inclusive, roughly $18,000 of that is GST you can claim back. That's real money, but it only applies once the project has actually crossed into substantial renovation territory. Get the classification wrong and you either miss out on a credits you were entitled to, or you get hit with a GST bill on the sale you didn't plan for. Now, once you know GST applies, there is a second decision that matters just as much. Most people assume it's simply 10% of the sale price. It doesn't have to be. There's an option called margin scheme, and it lets you pay GST only on the margin, the difference between what you've paid for the property and what you've sold it for, instead of the full sale price. Let me walk you through the numbers, because this is where the real savings sits. Say you bought a property for 600K, you did a substantial renovation, and you sold it for $1.1 million. Under the standard rule, GST is 1/11th of the full sale price, that's 100,000. Under the margin scheme, GST is 1/11th of the margin. The margin here is the sale price minus what you paid, so $500,000. 1/11th of that is around 45,000. That's the difference of over $54,000 on one sale. There is a catch. When you work out that margin, you can only use what you originally paid for the property. None of your renovation costs, building materials, or construction expenses can be added into that number. The renovation cost sits completely outside the margin calculations. It doesn't disappear though. You can still claim it back separately as a GST credit just through the normal process rather than through the margin. And note, the margin scheme isn't automatic. You and the buyer need to agree to it in writing and that agreement has to be in place before settlement, not after. Miss that step and the option is gone. Let me tell you about a client who lived through exactly this because it's a case that comes up more than people think. She bought a rundown 3-bedroom house for 600K, planning a quick flip. The plan was simple: new paint, new floors, a kitchen refresh, standard cosmetic work. Then the electrician found the wiring was unsafe, so she replaced it throughout the house. The plumber found the same problem with the pipes underneath. And while she was in there, she knocked out a wall to add an ensuite off the main bedroom. None of those felt like a big decision at that time. Each trade just told her what needed fixing, one job at a time, but added up, and she just ticked both boxes for substantial renovation: a full rewire, a full replumb, and a layout change, all affecting the building as a whole. She spent 200K getting the place ready and sold it for $1.1 million. Those are the exact same numbers I walked through a moment ago. Only she'd priced the sale assuming it was still cosmetic work, meaning no GST owing. It wasn't cosmetic anymore. The property had become new residential premises and the GST was payable on the sale. And because nobody had the margin scheme agreement signed before the settlement, she couldn't use it either. She paid the full 100K in GST, not the 45,000 she could have paid if that one piece of paperwork had been sorted beforehand. 54,000 gone on a project that was already on a tight margin. Not because she did anything wrong with the renovation itself, but because nobody added it up before the sale went through. There's one more piece people get wrong, and it has nothing to do with the GST at all. It's income tax. If you're renovating and selling properties as an ongoing activity, or even doing it once with a clear profit motive, the profit is not a capital gain. It's ordinary income. That matters because capital gains held over 12 months get a 50% discount or indexation benefits. With the new rulings, flipping profits don't get that discount, not even close. The full profits get added to your taxable income and taxed at your marginal rate, or at a 25% if you are operating through a small business company. I've seen flippers plan their finances around a capital gain discount that was never going to apply to them, and it changes the entire return on the project. So your tax position on a flip comes down to three things: whether the renovation is cosmetic or substantial, whether you set up the margin scheme in writing before settlement, and whether you're treating the profit as ordinary income from the start, not as a capital gain you'll sort out later. Get those three right, and a project like this can save you tens of thousands of dollars. Get them wrong, and the ATO bill can wipe out a big part of your profit. If you're planning a flip or you're already pathway through one, get the classification checked before you settle, not after. Once the sale goes through, your options shrink fast. Head to the link in the description and book a call with us before you list your property.